The 1970s, higher gas prices in the West, higher revenues for world oil producers, flooding financial markets with so-called petrodollars. In 1971, a monetary crisis had forced President Richard Nixon to take drastic action. But the oil shocks led to no financial crisis, no emergency economic measures. Why not? What prevented the monetary crisis that never happened? Exchange rates. Did floating rates work? Allied troops were still sweeping across Europe in 1944, trying to restore the world's political stability, when the resort town of Bretton Woods, New Hampshire, welcomed Allied economists to establish a new and stable world monetary system. They agreed on a fixed or adjustable peg system for setting exchange rates. The value of major currencies like the British pound and the French franc would be tied to the value of the currency of the only healthy industrial country in the world, the US dollar. And the value of the dollar would be tied to gold. Exchange rates would be fixed the way decisions had been made at Bretton Woods by government officials. Under the stability of the Bretton Woods system, the economies of war-ravaged nations recovered and prospered. And a world economy that had spent a generation following American leadership developed many leaders. But a multilateral world economy operating under a US-centered exchange rate system was a recipe for monetary trouble. Repeatedly during the 1960s, currency speculators would sell off large amounts of troubled currencies, forcing governments to spend billions to hold currency values up, only to be forced later to devalue drastically. More than a decade of crises came to a head in August of 1971.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
The closing of the gold window destroyed an essential element of the Bretton Woods system, the dollar's convertibility to gold, and currencies were allowed to float, to follow the market, while U.S. financial policymakers and their allies kept trying to patch the fixed rate system. But in early 1973, with no solution in sight, the world quietly gave up on the Bretton Woods system. Massachusetts Institute of Technology economics professor Paul Krugman.
There was not a day in March 1973 when policymakers suddenly decided that we should have a floating rate system. There was a day in March 1973 when speculators thought that such a decision might be coming and started moving vast quantities of money in anticipation of such a decision and forced the hand of the policymakers.
Now the market, not government officials, set exchange rates. Markets were subject to unpredictable swings and fluctuations, but many economists welcomed greater market influence on the exchange rate. And in 1972, one of them, George Shultz, became U.S. Secretary of the Treasury.
The market is influencing it no matter what you do. It's only a question of whether it's going on more or less constantly in exchange trading rooms, or whether it's a question of trying to build a dam at some point and the market forces hit the dam and finally they break the dam and the water floods over in a great sense of crisis and people travel to Geneva or Zurich or somewhere and have their pictures taken, gravely declaring that they're going to defend these rates, and the next day, bang, the market breaks through them. So I think in that sense that the more market-based, directly market-based system is preferable.
But Edward Bernstein, one of the architects of the Bretton Woods system, thought market-driven rates could be clumsy and dangerous.
What the market doesn't do is act efficiently in the sense of properly giving you the right price. If the market makes a mistake on the price of wheat, it isn't so important. But when they make a mistake on the exchange rate, it's devastating because it covers the whole economy.
Just 6 months after the world turned exchange rates over to the market, the floating rate system faced its first test, the oil shocks of the 70s. Higher gas prices meant higher revenues for world oil producers, paid in the currency used for most international transactions, U.S. dollars, so-called petrodollars. Oil producers looked west for petrodollar investment opportunities. But could the floating rate system absorb the flood of petrodollars? Or would the tide of mobile capital swamp the new system as it would have the old, setting off another round of monetary instability? George Shultz said that a fixed-rate system would have precipitated another monetary crisis.
The market would have forced changes, but they would have come in that same pattern that I referred to earlier, a big effort to hold on to rates that were increasingly seen as not right by the marketplace, intervention, which puts money in the pockets of the exchange traders, and then the dam breaks and the currencies change, and then you do it all over again.
Edward Bernstein acknowledged that floating rates had averted an exchange crisis, but as to stability,
far from stabilizing the balance of payments or the exchange rates, the floating rates exaggerated it.
who was right? Had floating exchange rates served the world economy well during the oil shocks of the 70s?
The oil shocks were a terrible blow to the world economy. But what they were not accompanied by was any major international trade disruption. In fact, world trade continued to grow rather rapidly, rather smoothly, continued to be an engine for growth right through these terrible shocks to the international system. We didn't make the oil price increase painless, but we avoided having a lot of extra pain that might have come if we'd had some other monetary system.
It wasn't the last time that changing economic conditions gave exchange rates a rough ride. But floating rates made a rough ride just a little smoother.